Welcome to the DIY webinar sponsored by Inland Private Capital. Our topic today is recession-resilient alternative assets and sponsors underwriting standards. I'm Damon Elder, publisher of the DIY. I'm joined today by Keith Lampi, President and CEO of Inland Private Capital, Nate Kuhn, President and Advisor with Kuhn Wealth Management, Ken Nitzberg, Chairman and CEO of Devon Self-Storage, and John Wieker, Chief Investment Officer of Core Spaces. Thanks to all of you for joining us today. As I think we all know, the economic environment has changed dramatically in recent months, certainly within the last year. The Federal Reserve has been fighting persistent inflation with a series of interest rate hikes. The most recent will probably come today during this webinar. And in the last week or two, we've seen a banking crisis emerge with fears of a looming recession growing ever stronger. So clearly, this is one of the most challenging economic environments we've seen since the Great Recession of 2008. Of course, this environment makes real estate deal making significantly more challenging. And while we have definitely seen a slowdown in real estate deal making, there are certainly recession resilient assets that continue to perform well. And we're going to be discussing that today. So generally, what's happening out there and what should investors and advisors be paying attention to in our current environment? I'm going to start with Keith. Keith, given the rising interest rate and inflation concerns, many investors, advisors are cautious. What opportunities are you seeing out there in the alternative real estate sector?
Sure. Thanks, Damon. Thanks for having me. So it's an interesting question, and when you break it all down and you list the amount of things going on in the macroeconomic climate, there's certainly a lot there to sort of unpack and try to distill and figure out where your path forward is. From my perspective and Inland's perspective, we view the market through a fairly wide spanning lens. As many people know, our assets under management footprint pretty much spans every segment of commercial real estate. So we don't necessarily have a dog in the race in terms of one versus another, which agenda to push or drive forward. So we really take a step back and look at things holistically. And I think given all of the economic turbulence that the market is currently experiencing, I think we remind our investors of to view the market through a long-term lens, right? Short-term thinking can really stymie one's investment criteria and decision making. And given all of the headwinds our market is experiencing, we've found through our investment thesis a consistent focus around non-traditional alternative assets. What I mean by that, assets that aren't in the core food groups of commercial real estate investing. So traditional assets are typically retail, office, industrial, and residential. Where we've began accelerating our AUM, given the macroeconomic climate, anchors on self-storage assets, healthcare-related assets, and student housing assets, each of which, again, are not in the traditional segment of commercial real estate, but the common theme that ties all three of those strategies together is the asset performance is driven by demographic demand as opposed to economic demand. And again, each are relatively different, but when you anchor a strategy on demography, which is interesting, our industry is kind of anchored on that, but when you anchor an investment thesis on demography, I'm not going to go so far as to say what's going on in the broader economy doesn't matter, because it certainly does. But I think you're insulated from a lot of that. And by experience, just looking at the past 12 months, we've seen each of these sectors behave and perform differently than your traditional sectors as a result of that demographic driven demand. So in addition, there are a number of tailwinds kind of driving performance, which we're going to get into I think as we go further into each sector. But that is by and large the simple answer to the question. Our investment thesis, near term and through a long-term lens, is very much anchored on non-traditional alternative property types.
Well, let's discuss some of those. What assets are continuing to perform well? Which do you continue to think are going to perform well through, given the headwinds that we're seeing? Self-storage you referenced. I know that you've been investing heavily in self-storage. Why do you like self-storage so much? Give us some specifics. What are you seeing there? What do you anticipate seeing?
Sure. Self-storage, I mean, it's a poster child for exactly what I'm describing. real-time update on performance. We just announced distribution increases on our entire self-storage platform. So that gives you a glimpse into the past, 12, 18, 24 months of operating performance. We benefited during the early days of COVID by again, that needs-driven, demand-based or demographic-driven demand. So we saw occupancy surge for numerous reasons, the work from home phenomenon, other kind of behavioral trends. There was a slowdown in new supply. Development, new construction starts essentially halted. So we saw a lot of markets become undersupplied, and it gave landlords incredible pricing power. Now that's not new from the storage industry's perspective, and Ken Nitzberg can certainly comment on some of this. But we saw the sector thrive during two black swan events. First, the financial crisis of 08, 09, then the COVID-19 pandemic. And so it's not enough to end the narrative and our bullishness on storage with what occurred, because I think there's some concerns that the market's going to flatten out and that things are beginning to normalize, which I think is appropriate and is certainly occurring. But we, again, believe based on the demographic driven demand, that this is a sector that is it's going to be continuous, steady, stable performance in a market where you may otherwise see turbulence, may see demand wane as a result of growing macroeconomic concern. And one last point I'll make, and this actually is applicable to many of the sectors, in a rising interest rate environment, it's always important to push performance, push NOI. But in a rising interest rate environment, if your objective is not only to generate income, but also preserve capital, your NOI has to grow in accordance with how rates are increasing. And so we've seen storage perform incredibly well in that regard. But that's kind of my high level assessment on that particular sector.
Why don't we bring Ken into the conversation then? Obviously, I think it's a perfect time. Ken, you've clearly been around for a long time. You've gone through several economic cycles. What's so great about self-storage? What are you seeing out there?
Well, we've been at it for 30 years. So we've been through a number of ups and downs, including what happened in the early 2000s with the dot-com busts, and in 2008, 9, 10, whatever. And of course here with COVID. And in my 30 years, the 2.5, 3 best years ever for the industry has been the COVID years. When COVID first hit, we were pretty scared to death that the world was, going to come to an end, and Chicken Little was an optimist back in March of 2020. But very quickly, we saw the demand went way up, as people were clearing out that extra bedroom or closet to use it as an office and work from home, or moving from Manhattan to Iowa because it was cheaper to live and you could work from home. And they needed to put their things somewhere. So occupancies went to all-time highs. And in 2021, 22, NOI increases, rent increases were in the 20% per year range. When we underwrite to buy or finance a project, we typically use 5% as our traditional bogey. So we've had an unprecedented period. Unfortunately, we can't, annualize that and carry it forward 20 years. It doesn't work that way. But even with we're coming back towards normality, we're still looking at 8 to 12% gains this year, which on a historical basis are still exceptional. And you got to put it in a little context. If you have 3 floors of an office building in Midtown Manhattan and the rent's $80 a foot a year, a 5% raise is an awful lot of money. But if you have a self-storage unit that's costing you $100 a month, the 5% raise is $5. And not many people are going to get upset with you and move out over $5. And the inertia to move everything is pretty strong. So it's been a very great period. And actually, I'm kind of a fan of the higher interest rates, because when interest rates are 3%, and every Tom, Dick, and Harry can get into the market and go to the bank and borrow 80% of the construction cost at 3%, that deal screams. But when you have to put up 50% down and you can borrow at 7% for construction loans, doesn't scream so much. So we're going to shake out some of the people who really shouldn't be in the business anyway, which is going to make it better for the substantial operators. So you're not very optimistic.
So Ken, you're not necessarily seeing a huge impact in your ability or other large players' ability to get deals done in this rising interest rate environment. It's, like you said, really going to shake out some of the smaller players.
Right, the ones that are undercapitalized, or if 3 years ago or 5 years ago, Damon, you and I formed a little partnership, went to the bank, said we want to borrow 80% to build a storage facility. The answer was no problem. How soon do you need the money? And today you go do that, and the banker says, how many have you done before? And how much you putting down? There's a bank down the street. Let me give you the guy's card. He might talk to you. We have no interest. So it's tightened the market for the less well-established, less sophisticated. And we've also seen a big sea change in how our business is run. You have to look at the industry a little bit. It's because it's hugely fragmented. Nobody knows for sure how many are out there. The educated guess is there's somewhere between 55,000 and 60,000 facilities. About 2.8 billion square feet, which sounds like a lot, but it's less than the square footage of the office floor plans in Manhattan. And it works out to about 8 square feet for every man, woman, and child in America. So you look at markets and you see how much is in that market. And markets, by the way, are 3 miles in diameter. People will drive about 15 minutes or about 3 miles to go to a self-storage facility, because in many markets, they'll pass a couple in that drive. So if you talk about a city, say Chicago, where Inland's based, you got to look at little 3-mile circles all over the place, not the whole MSA, because that's not the market. Someone's not going to drive from, I think one of you said you were in Schaumburg today, to the north side up to, I don't know the city's well enough there to be intelligent here, but 40 miles away for a self-storage unit. You just don't do that. It's like grocery stores. You drive to one that's half mile away, not 40 miles away. So we've seen a whole new group of customers as well. For a long time, the industry thought that the millennials wouldn't be our clients. They still live at home. They have the 80-inch screen TV, and mom and dad has the 30-inch black and white screen because they can't afford the 80-inch one. That's all changed. And the millennials are now using our product big time, and they've found it and they like it, and it's not going to go away. So according to the latest statistics from the Self-Storage Association, which is the industry not-for-profit trade group, roughly 1 in every 10.5, 11 people in the US are currently renting a self-storage unit. That means we have quite a bit of occupancy to go, quite a bit of market to go after. But 100% of the public knows what it is. Everybody knows what it is. You don't have to educate anybody. We did a storage facility many years ago in Holland. We were the very first one there in the Dutch country. And the problem was nobody knew what it was. We'd have to educate them to come rent, but what it was for. We don't have that problem in the US. Everybody knows what it is. So we've got a huge population yet that aren't currently using it, but know what it is. And the demographics are changing. So we think the future looks very bright. It's not going to be another 21 and 22. Because if that happens 5-6 years in a row, we own the whole world because of the beauty of compounding. There's no danger of that happening.
The storage has performed great for a number of years, long term. I mean,
yes,
public storage and others in the publicly traded realm, as well as others within the smaller non-traded realm, have certainly produced well throughout a long period. But let's talk about one that I think has gained in popularity in recent years, and that's student housing. Now, it's a very interesting sector, I think, because obviously during COVID, we saw most of the schools shut down. I think a lot of the students obviously went home, did remote learning, et cetera, et cetera. But student housing has certainly bounced back and has done well. So why don't we talk a bit about that? Keith, what's Inland's play in the student housing arena? Frankly, I don't know that you've been real active there in recent years, but please illuminate me. And then we'll bring John in as well. Of course, Core Spaces focuses, one of their specialties is student housing.
Absolutely. Yeah, so Inland's dabbled in the student segment since, I would say, 2014. We've sort of had sneaky growth, though. Our AUM now is north of right around $1 billion. So we do have a pretty reasonable presence, and this has been an area of growth and focus for us. So we've been active both on the ground up development as well as purchasing of stabilized properties. All signs or all beginnings lead back to COVID. So to your point, Damon, there was a period of time where I think the market was pensive, right? Our students go, is this remote learning thing going to take off? Is it going to become a trend line? How does that look for student housing? And I think what we learned during the early phase of COVID is, that students generally want, and there's more to a college experience than what occurs in the classroom. So we, through tracking of key cards and kind of understanding what our resident behavior was, many of our students stayed on campus, even though they were learning from their apartments. They stayed on campus. They wanted to be around their peers as opposed to back home in mom or dad's basement. Now there is a bifurcation of the industry. I definitely don't want to paint with too broad of brushstrokes. And my guess is John's going to get into this a little bit. But we see the growth in enrollment kind of coming out of the post-COVID era, and in many respects it was pervasive leading into around your tier 1 Power 5 universities, schools that have a major presence, a sort of city built around them, a major football team, basketball team, and many of the schools we see playing football on a Saturday are the universities that have really benefited from an acceleration in applicants, enrollment growth. And what's been sort of interesting about the sector, it's a play on residential, but landlords never had the ability to push rents in student the way we did in the residential sector. What I mean by that is you basically get one bite at the apple each year, right? You're pre-leasing for the following academic year. And so you're setting your rents and you might toggle those a bit, but let's unpack the past few years, right? We had COVID, so we had to be measured as landlords. So there wasn't a lot of rent growth between 20 and 21. 21 to 22, still kind of measured. Fast forward to today, now we're seeing what the residential market experienced. We're looking at inflation, and we're seeing a remarkable opportunity to push rents in an outsized fashion, almost making up for lost time. And we view that as a near-term tailwind. But again, looking at the demography, looking at demographic-driven demand and the application surge, the shortage in supply, it's a sector that checks all the boxes, similar with a different twist to what we just described with storage. So it's definitely an area of focus and something that we continue to attempt to scale within our business.
Well, John, like I prefaced before, I mean, Core Spaces specializes, one of its specialties anyways, in student housing. What's the secret sauce? What do you really look for? I mean, what do you drill down to really underwrite these assets and determine what's going to work in the near term and in the long term?
Yeah, that's a great question. And we've seen a lot of tailwinds coming out of COVID in the student housing space, similar to self-storage. It starts really with what happened immediately, back in sort of February or March when COVID was first coming out. We had 96% occupancy at the time, and our physical occupancy dipped to 70%. I think that number would probably surprise a lot of people because the common wisdom is that all the students went home. And it's true, if you lived on campus in a dorm, those dorms oftentimes shut down. You literally couldn't get back into the dorm. What that meant was we actually had more demand for our off-campus product because people who wanted to stay in their university towns for whatever reason, they couldn't stay at the dorms. We got applications the day after the dorms closed and increased our occupancy throughout the year, our paying occupancy, as a result of COVID hitting. Our physical occupancy, I mentioned, did drop to 70% for a short period of time, but very quickly went up to 90%. And in the middle of COVID, we were pre-leasing for the following academic year. And we were astonished to see the number of leases we were signing every day as the universities were actually shutting down. And so what became obvious to us very quickly was that there was going to be a bifurcation in the way on campus and off campus was viewed. Well, we historically had been predominantly in the off campus student housing game, but really decided to stick with that and continue to grow in off campus because we knew that we could control our own destiny and that we would be able to offer our residents the protection of some added security and safety measures in COVID, but the ability to be able to continue to use their residences, and that would be an attractive option for them. What else happened in COVID, though, was that it became harder to finance deals. There was just skepticism, broadly speaking, about the financeability of real estate, multifamily, and student housing in particular among the banking community. And student housing is in a sector where the product that's delivered today, the purpose-built product, looks very different than the product that I'm sure we all went to school in or lived in when we were in school. The kids predominantly don't live in dorms anymore. They live in something that looks more like an apartment building, but has some special features. Generally has a little bit more of a amenitized product. And what I mean by that is a little bit more social gathering areas, more focus on fitness, on wellness, on social gathering, and then also has kind of units and bed types that are more tailored to what the students are looking for. They have their own little private space where they don't have roommates, but they don't need a significant amount of that private space. What they want is larger common areas to be able to aggregate with their roommates, at the end of the day. And so there's been 45,000 beds delivered per year into the kind of, as Keith was describing, the tier one, as we call it, the Power 5 and large state university markets over the last 15 to 20 years, as that new purpose-built product has become the predominant product out there. And as a result of COVID, it's really that new supply has been cut in half because the bank financing has been more challenging for development deals. So what's happened is we've had this the demand keeps growing for the product, but there's been less supply, and that's really put rent growth, at our back as well. We saw about 5 or 6% rent growth last year, and we're in the middle of pre-leasing for the next academic year, the academic year that will start in the fall of 2023. We're currently 87% pre-leased in our portfolio, and at rent growth of 11 to 12%. So we're seeing incredible tailwinds right now.
So from a more macro perspective, how is the pipeline looking? For you, the industry in general, inland, from a development acquisition perspective. How is the new environment changing that flow? Are you seeing some hiccups? Are you seeing some difficulties that were certainly not around, a year ago?
Yeah, I mean, not in the fundamentals at all, which is, incredible. Like I mentioned, we were 87% pre-leased for next year. If you go back 12 months ago to the same date, we were only 76% pre-leased for the following academic year. So we're 11% ahead on pre-leasing year over year, and we're experiencing 11 or 12% rent growth at that same time. So the fundamentals are fantastic, and that's really driven by the supply being down and the demand continuing to be up. And really what's happening among the various universities is students are more interested in going to these tier one Power 5 schools today than they were historically. And so while enrollment across the country is only up slightly, enrollment at the tier one universities, the universities that we predominantly focus on, is up significantly. It's up 2-3%, and that's happening in the face of limited supply growth, and that's created some imbalances that create great opportunities for rent growth for us.
Nate, I want to bring you in. You bring, I think. Oh, sorry, Keith, go ahead.
Yeah, I just wanted to comment on your question too. I mean, so fundamental soundness, whether we're talking about student or storage, applicable, we covered that. But to your question around getting deals done, right? I mean, I think on the development side of the aisle, that's a little bit more straightforward. Maybe you lower your leverage, maybe you absorb a higher carry cost. On the stabilized front, there's still a friction there, right? I mean, cap rates have widened out modestly, but they haven't widened out enough to where it's a no-brainer to obtain positive leverage. And sellers are looking at what we're describing, and they're saying, look at how well I'm doing. If I don't get my price, I'm not selling. And buyers are saying, your price doesn't allow me to borrow money at an accretive level. So there's this disconnect that I think has created a friction, has slowed down stabilized transaction. There's not a lot of sellers selling their asset through desperation, not a lot of distressed sellers. So I think it's going to take a while for that to come together. So there's kind of a tale of two energies, if you will. Development's one thing, stabilize is another. And that's what makes this not easy and something that we have to continue to navigate as an industry.
Yeah, Keith, I think that's a great point. If I could just add one more thing, Damon, what we've been seeing is absolutely been an increase in the cap rates that are happening on marketed transactions today. And student housing has probably gone up 100 to 125 basis points in the last 12 to 15 months. And even still with that increase, Keith's right. There's negative leverage out there in the marketplace. So what we've been doing is we've been buying deals on an unlevered basis where we can, because of that negative leverage, knowing that we are pre-leasing for next year at high rent growth, and that we're going to be able to grow into a place in the next 1 or 2 years where there won't be negative leverage anymore. And then put financing in place when you don't have that negative leverage situation anymore. And I think that's sort of one of the creative ways that we've seen deals getting done right now. Although it is absolutely true that volumes are down significantly.
What's interesting about that, though, I'm sorry, Damon, I know you're trying to get in there. I know what's interesting about that, though, is I think a lot of people look at cap rate as the ultimate metric on price, and it doesn't necessarily translate that way, right? Like if you're talking about selling a $100 million asset at a 4 cap, and now today you're maybe need to sell that asset at a 5 cap, if your rent growth has increased by 10%, your higher cap rate is being applied to the higher NOI. So you might still get your $100 million, right? And I think that's creating the disconnect. Buyers are saying, no, I'll hang on, because even if cap rates widen out on me, my value may return or stay the same. So there's a timing element of this, and that's the dichotomy we talk about, right? It's normally when we're in this period of dislocation, performance is strained, and everybody's trying to find their footing on valuation. In this regard, values may be up in the air on a lot of fronts because people are looking at macroeconomic conditions, but the fundamentals on some of the asset types we're describing are phenomenal. In some instances, the best we've seen on record in a number of years. So it creates an interesting environment.
I would add one other thing in there, Damon, if I could. I think cap rates are extremely overrated. If you give me the P&L for any property and tell me what cap rates you want, I can prove it to you. We bought a site actually with Inland about 4 years ago, and the going in cap rate was 5. And it was this one-off owned by one family that actually was a Korean family that lived in the office. And they charged the kids tuition and the family car and the wife's hair appointments and everything else to the site. When we got in there and cleaned it up, the cap rate was 8. Because you can play with that P&L and do all kinds of strange things, especially on assets that are in the $8 to $15 million range instead of the $100 million range. There's just a lot, and there's a whole other set of cap rates. It's called the broker's cap rates, because when they're selling something, they adjust the P&L to reflect what they want to get the cap rate they think the buyer wants to pay. So we look at something different. We look at replacement cost. We look at competition in that immediate market. We look at deferred maintenance that needs to be implied. Cap rate's interesting, but it's only one of many metrics, and it's usually not the best.
Gotcha. Yeah, it's
at least in our sector.
Process. I want to bring Nate in because Nate brings a very unique perspective, I think, as a wealth advisor, who obviously, you're open to alternative investments, the non-tradeds, et cetera. What do you look for? What are you, advising your clients to invest in currently? Obviously, multifamily has been very, very popular for a number of years. Industrial, we're seeing the emergence of storage in recent years, student housing, medical office buildings, other healthcare facilities. What are you looking at, Nate? What keeps you up at night? What are you confident in from your perspective as a wealth advisor?
Yeah, great question. And again, thanks for having us. I think, as everyone here and John and Ken were talking, and Keith, it's as an advisor, we don't know any of these assets typically a mile deep, like John and Ken obviously were able to speak to. And so even today, like I'm taking more in when we're talking about these underwriting standards, it really comes down to, knowing who you're working with, going back to that high level of, what do we need to underwrite to, like really understanding, diving in with these guys and making sure you're understanding as an advisor that these guys know what the heck they're doing when they're buying properties. And that's really what we're looking for to start with when we're deciding who we're going to work with and working with a company like, with hearing from Keith from Inland and kind of the products they're bringing. I think also the term alternative investments, a lot of times when we're talking with the client, even a year ago, an alternative could have been an alternative source of income, right? Because interest rates were so low, you had retirees searching for income. And maybe, again, it always comes down to what's appropriate to the client, but maybe an alternative investment that had a higher cash flow than, say, what you could get at a bank or a CD was the reason why you were maybe considering an alternative investment. And where we're at today with interest rates higher, perhaps the reason you're looking for alternative investments is an alternative to what happened in the stock market last year, right? So there's different reasons we're using alternative investments, and it should all be driven by what the client needs. So it's certainly not a one size fits all solution. And what we want to do for our clients is have a kind of repertoire, a knowledge base of a variety of different investments that are alternatives that might be income focused or total return focused. That again, we would know based on what the client's looking for, what solution might be appropriate for them. And I think, really today when we're looking at this, where you could say, hey, CDs are now paying 4 or 5%, maybe that's close to what some of these alternative investments are paying. So then you have to go back to the sort of what's the fundamental reason why we have these alternative investments. It's because they're not correlated to what's happening in other asset classes. And I think that's really what John and Ken and Keith really spoke about earlier. And that's why we continue to look at these alternative investments. And I think it's important to note too, with not only interest rates being higher, but inflation still being here, where we look at these alternative investments, again, diversification from our traditional assets that we're managing for clients, hopefully generating some income along the way, depending on the structure. But also you've got that opportunity to maybe keep pace with inflation versus something like maybe just something at the bank where, yeah, you're getting nice income, but all you're getting back at the end is your principal. So I think that's another consideration when we're looking at these alternative investments for our clients.
How have you seen the openness or the adoption rate from your clients when it comes to alternatives? Has that been growing? I mean, we constantly hear, and DIY reports constantly, that demand for alternatives continues to grow among individual investors, institutions, and advisors are certainly adopting them more readily. What are you seeing in your practice, Nate, from that perspective?
Yeah, I mean, I guess our clients have been used to us sort of always, from the beginning of a relationship with our firm, we kind of hammer the alternative investments as a necessary part of a person's allocation, depending on their net worth, kind of where they're at. So I think our clients are kind of used to that over the years of working with us in alternatives. But I think what I've seen maybe more different in the industry is just the accessibility to alternatives that different sponsors are trying to bring to the market and put in front of advisors that maybe in the past hadn't been as receptive to alternative investments, and maybe making them more approachable, meaning like lower minimum investments for clients, maybe more of ease of use for how you're going to get these applications in and going for investors. So certainly that's some of the stuff we've seen kind of penetrate into the market, is just more accessibility to more advisors as well.
Okay, let's turn back to real estate asset classes, and one that I'm particularly interested in and have a bit of a background in is healthcare real estate. I know Inland has entered that space fairly aggressively in recent years. What do you like about that, Keith? I mean, obviously COVID had a dramatic impact on various sectors of the healthcare space. Assisted living, senior housing, and others were obviously hammered hard, and inflation has certainly hurt the performance of many of those assets. Medical office has been more resilient, I think. What do you like about healthcare? What are you looking at? What's Inland think?
Sure. Well, at the risk of sounding like a broken record, again, it's the demographic-driven demand that each of these sectors benefit from, right? So you made the point, medical office, I mean, that's been kind of a bell cow throughout COVID, particularly if you have credit behind the tenant and the lease. These are areas that have continued to service, clientele, continue to pay rent on time, and has that durability and income, but more bond-like characteristics, honestly. So our shift in focus in the healthcare sector has been mostly in the senior living segment of the market. Our sort of sweet spot within that segment is Class A, low acuity continuum of care type facilities. What we've observed is, yes, to your point, Damon, early days of COVID, there was some turbulence, but as the market began finding its footing, a lot of the same characteristics are pervasive. There was pent-up demand, there was limited or muted supply, and now the market is benefiting from capturing that pent-up demand. And so we're seeing occupancies surge. We're seeing an opportunity to push rental rates. Handful of other tailwinds. Social Security just got increased 8.7%, right? Which is a big jump from where it's historically reset. So in the right market, with the right operator, with the right kind of operating structure, we see green shoots. And again, viewing the market through a long-term lens, we believe that demand is sustainable, durable, and should provide a fair amount of resilience in operating performance on a forward-looking basis. Now, this is, out of the three categories, is probably the one sector where it never it still hasn't really returned from a tightening in cap rates perspective. So there are opportunities, I think, out of the three. There's still a stigma with certain buyers. So you can actually find some opportunities to buy assets at higher cap rates. Within the senior living sector, it isn't as difficult to obtain accretive leverage, which I think is a unique kind of slant to that particular sector. So it's an area of focus, like I said, not just near term, but long term, which is the lens through which we view the market.
Well, let's go to some classes that are typically and remain very, very popular among real estate alternative investments. And that's, of course, multifamily and industrial, which have both, seemingly performed, on a macro level view very, very well. And people continue. We know there's a massive demand for housing that is unmet in this country. Why aren't we talking about multifamily? Why aren't we talking about industrial? Office, I think everybody understands the challenges there, but why aren't we diving deeply into industrial and multifamily? I'll open that up to the group, but I think Keith, probably perfect for you to start.
Sure, I will. From a multifamily perspective, I think the market knows we do have a very positive outlook. It represents 40% of our AUM. And that's both traditional multifamily as well as within the BTR, built to rent segment of the market. That said, I feel very good about the assets we've purchased. We've experienced over the past 24 months, 10, 15 years worth of rent growth, all truncated in that one period of time. So performance has been surging. We are starting to see rents taper, level off a little bit. I think it was a sector that lenders and developers, quickly re-embraced, and so new supply was probably a little further along in terms of new construction starts and ultimate deliveries. So there's still a housing shortage. I think it's still a great sector. I don't characterize it in the same universe as what we're describing, mainly because it's a traditional sector. It's
right.
Not an alternative. So there is demographic driven demand. We're seeing your average American willing and sometimes desiring to rent at a later stage in life, where there used to be a stigma around that. So it's a good sector. It's outside of this scope a little bit. A comment quickly on the industrial side. I mean, by and large, most of our activity in industrial has been net lease. You're anchoring on credit. Tenants like Amazon and FedEx and logistics or distribution have been kind of pervasive throughout that market. I think it was a darling during the COVID era because we saw supply chain shortages and we saw all of that went into getting product into consumers' hands. I think some of that has waned a little bit, so I think we are starting to see cap rates widen out a little bit throughout that segment of the market. I think it's still durable. I think it's considered a fairly conservative investment strategy, but it has kind of lost a little bit of steam now that we've seen the market normalize. And again, it's probably more of a bond alternative if you're looking at credit and long-term lease. Landlords, we don't have the same ability to push rents on a fixed income lease the way we would within an operating asset like storage, senior, or student. So that's my comments. I'm curious to hear the rest of the group.
Yeah, I mean, another thing that jumps out to me would be that, all the sectors we've been talking about today, sign what's in the real estate world, generally shorter term leases, right? Maybe 6, 12, 18, 24 months, but it's all leases that we can lean into what's happening in inflation right now and take advantage, capitalize on the fact that we can reprice our rents on a very regular basis to capture the current market dynamic. If you're in industrial or office or retail and signing much longer term leases, when that inflation didn't exist, you may not be able to take advantage of it the same way.
We have a whole different dynamic in the storage sector, and I've been in all the other categories in a previous real estate life 30 years ago. We can raise rents every month. We don't have any leases. Technically, we have rental agreements. They're 30-day in duration with an automatic evergreen clause. And so we have some 55,000 tenants today across America, and we have a revenue management system that's analogous to what airlines use and hotels use for pricing. And we go through, especially during the so-called leasing season for our industry, which is about April till about August. People don't usually go running out renting storage at Christmas time. or if they live in a weather constrained area like Minnesota or something. But during the leasing season, we typically raise rents every 7 months on every tenant, assuming that the market and where that store is will support it. And again, very little changes make huge differences. And I don't know if we have time, I'll give you a simple example. If you had a 100,000 square foot storage facility, and forgetting hallways and offices and restrooms, they were all what we call in our industry a 10 by 10, all 100 square feet, and you had 90% occupancy, which is considered above stabilized, 85% is considered stabilized in the storage business, and they were all renting for $100 a month, and you came in and raised everybody 5% or $5. You would lose a couple of tenants, not because of the $5, but because you forced them to think about what they're storing is it worth the $100, not the $5. But if you did that, you would probably be able to backfill pretty quick. And now you have 900 units at $105. That's $4,500 a month more. That's $54,000 a year. You didn't add a penny of expense to do that. And at a 6 cap, you just added $1 million in value to your building. You can't do that with any other real estate asset that I'm familiar with. So the storage sector has, we've always been looked at as kind of the, pardon my French, the bastard stepchild, but we're now considered an institutional quality asset. And we have great ability to raise rents that the other asset categories simply can't do as frequently or with this least amount of tenant disruption.
Nate, I want to come back to you again, because you have a pretty unique perspective. So we're talking about, again, as Ken said, with these formerly considered more niche real estate plays that are becoming much more popular. Do you have a problem in the education process with your clients or your advisors in introducing some of these, heretofore more unique investment asset classes, or are they embracing them readily and understanding, the potential benefits they can bring?
Yeah, I mean, I think it's a good question. I think I want to start by saying, it's not like we're opposed to multifamily at this point. So maybe the alternative assets is alternatives to multifamily. We're not, all these assets are alternative to what I consider as a wealth manager, which would be, your traditional stocks and bonds. And we still allocate to multifamily. It's just, again, these more niche areas. But again, having these examples and diving into on the phone calls with a person like John or Ken or my contacts at the different sponsors, getting us up to speed on sort of the advantages and some of the risks of these different asset classes. I mean, evaluating different investment profiles while they're different assets, it doesn't change, right? We want to take a look at what are the potential tailwinds, what are the potential hiccups along the way, and then kind of analyze what makes sense for a client, understanding those risks. And I think it's also important to know, like Keith pointed out, if you're going out and developing a deal, the risks are much different than if you're buying something that's stabilized, right? So for somebody who's looking for cash flow, a development deal doesn't make any sense, but a stabilized asset would. For somebody who's looking for total return, probably that development deal makes more sense. So it's important as an advisor, I think, to understand and know these different products and have a comfortability with being able to implement them into a client's allocation when appropriate. I think it's also important when we look at these different asset classes to understand that they can be held in different structures, right? I want to look at things differently if I'm doing a 1031 exchange for somebody where it makes up 60% of their net worth or a substantial amount of their net worth versus if I'm doing something like a younger client who's investing $50,000, but they're making $1 million a year. They might have a different risk profile and how these assets function in a DST versus a fund versus an opportunity zone. Those fundamentals are going to change greatly. And that's really where we want to reach out and talk with the sponsors to understand, like, hey, what's the opportunity here? What's a time horizon? When might income start on these investments? And what are you going to do to manage these assets, right? Because like a DST, we already know what we're buying, but an OZ, a lot of times you're going into it, they might not own all the properties yet, or a fund, they probably don't own all the properties yet. So you kind of want to be looking forward as to what they're seeing as those opportunities as that fund continues to develop.
Well, let's stay with you, Nate, for a second. So again, the environment has changed dramatically in a very short period of time. And so I want to ask you from a micro and a macro perspective, from a shorter term and longer term perspective, what do you look at when somebody like Keith or one of the other sponsors out in the industry brings you a deal? How do you underwrite that? How do you determine if this is acceptable for your clients, your firm? And again, what are the key touchstones to your perspective, from your perspective?
Yeah, I mean, it's not just me looking at the deals. We have a broker dealer that we're affiliated with that really specializes in alternative investments. And I've been very fortunate throughout my career. I've been affiliated with 3 different broker dealers, and each one of the due diligence officers at those different firms has brought me a wealth of knowledge. And those guys, I mean, I'm spending a lot of my time meeting with clients. They're spending a lot more of the time reviewing deals. So I lean on them a lot. And I've been very fortunate, as I said, to really be at 3 places where we've just had outstanding due diligence officers. I think don't just say, give me the sales pitch. They want to dive into the numbers and understand that. But then even after they take their cursory look, I'm also looking at that with my team. We have a couple guys on our team that are also reviewing these deals. We're going to reach out to the sponsor. We're going to review things. And I think, the pro forma is very important. Look at what type of assumptions are being made, compare and contrast that, make sure it's reasonable, and start to look at if there's something like a DST, look at the specific property, try to get to some of the properties and really do your feet on the ground due diligence as well at some of the properties and meeting with the sponsor. So I think all those things, I mean, no amount of due diligence is going to eliminate risk, but understanding the risks and being able to explain those risks to a client and then knowing how the deal is likely to perform will probably at least help you decide which investments might be the right alternative investments for a specific client situation.
Well, let's flip the other side of the coin then to the real estate folks. How has your underwriting changed when you're looking at a deal or considering a deal? Again, giving the near-term changes, and let's factor in, what has just occurred in the last couple of weeks, which is this banking crisis. I mean, how is that impacting things? How's that changing your perspective? How's that changing your process? Keith, I'm just going to actually turn to you because, again, you're one of the biggest sponsors in the space. So how has your process changing, anticipated to change?
Well, I think your starting point is you maintain a disciplined approach, and you don't compromise on that based upon market fluctuations. Again, long-term lens is how most real estate is bought and financed. That said, you can't operate in a vacuum, and you certainly can't ignore what's going on in the market. So we draw from not only third-party research, but also our own experiences within a sector or market to help guide our underlying assumptions, which are going to be important in pricing an asset, maintaining a competitive level, achieving leverage that is acceptable. Obviously, we touched on that. So there's always an element of fluidity, but your financial model and your investment thesis is something that we really anchor on, subscribe to, and if you stay disciplined on that and you don't vary from that, which usually only occurs if you're looking at the market through a long-term lens, we've come out the other side in the appropriate way. So again, just sticking with that long-term view is a big part of what drives our process.
John, Ken, you want to add anything to add?
Sure, happy to. We haven't changed our process hardly at all with the change in interest rates. When we look to acquire either an existing storage facility or do a development, we look at typically a 3-mile market around the location of the site. We check for the number of competitors. So we see what the square footage of storage is available per person. The national average is about 8 square feet. So if we're looking at a market where there's 20 square feet per person, probably never going to get your occupancy or rent increases you want, because that little micro market is probably overserved. So we look at the competitive level. We look at basic demographics, traffic counts. How many people are there? Is the population growing or is it going down? What are the barriers to entry? Many cities don't like storage. So a lot of the mom and pops in our business don't have the sophistication, the time, the money, the people to go do a location that's problematic. We love those because that'll be a barrier of entry to competitors in the future. So we really haven't changed much. We're not greatly dependent upon interest rates. And again, if you look back with a historical vein, we've been doing this for 30 years. If interest rates are 6% today, 10 years ago, you would have killed for a 6% rate. That was great. You were a hero. You were a genius. We got so used to 3 and 4% rates, we forgot how the world really works. And as Keith referenced, we typically look at these at 5 to 10 year hold periods. So what's happening in 1 day or 1 week or even 1 year, as long as you stick to the basics and don't do stupid things or make outrageous assumptions, you'll probably be okay. And in the real estate world, it's very simple. You make money when you buy, not when you sell. If you buy it wrong, you probably will never get out of it. If you buy it right, even in a terrible market, you can probably get out intact. So it's very careful, and we'll be very careful about how we make our assumptions and what we do, and having done it for 30 years and done over 300 of these across the country and in Europe, we got a pretty good feel for what things work and what don't. So I think one of the important things, which kind of why we're here today, is you need to look at who's sponsoring it. In the case of Inland, or who they're working with, whether it's someone like us or one of their other co-sponsors, what's their experience level? How long have they been doing it? What's their track record? Are they overnight sensations, or they've been doing it for a couple of weeks now?
And I'll add on to that too with what just Ken said and echo that. I mean, I don't know if I said it as clearly in my part there about the due diligence. I mean, we want to underwrite every single deal we're looking at, and a fund or a DST, whatever the case may be, but certainly knowing the people you're working with, whether you're working with them the first time and really diving, obviously diving very deep the first time, or, for my case with working with somebody like Inland, where we've been working with them for years, it sort of also goes a long way to know the people you're working with and having that experience and seeing their track record. It's one thing to see a track record on a piece of paper and see what someone's done. It's another thing to have clients been in those previous deals and know what they had to do to achieve those numbers. So sometimes a return that doesn't look that great on paper might have taken a lot of effort from a sponsor because of the timing didn't work out well or something like that. So that's another thing we really, consider when we're looking at deals that we're bringing to our clients.
Well, let's pause there for a second, Nate, because, dozens of folks have been rushing into the space in recent years with all the equity that's been flowing in and the greater acceptance of alternatives from the investors. So, somebody can be waving a deal at you that they found online somewhere or whatever that's promising a 7.5%, 8% yield, and maybe a more conservative deals coming along with 5%. What's the conversation you have with the clients to either dissuade them from a deal you think may be a little overhyped or not as sound as maybe that lower deal? What's that conversation like?
Yeah, I mean, I think, it all starts with, I think if Inland needed to chase yield, if they need to do something that had a huge cash flow on it, we could all buy really bad property in the middle of really bad neighborhoods and probably have a higher cap rate on something. But it's helping clients understand, because a lot of times I use the analogy, people without the information, almost like bugs to that bug zapper. It's still 50 degrees out here in Chicago, but give it about 2 months, we'll have mosquitoes everywhere. And you just see those bugs just going right for the bug zapper. And that's how they are with that high yield sometimes, or like the highest cash flow, but they don't realize they can get burned by that. And I'm not saying every deal with a higher yield or a higher cash flow is bad. Maybe it's right for the specific investor. But you have to understand the differences between why is one paying a 5% initial cash flow or 4%, the other one's paying 6 or 7, right? I mean, you just got to look at the real estate. And then beyond the real estate, if that doesn't tell the story, then a lot of times the underwriting will. And you start looking at things like, what are they doing to maybe supplement the cash flow? Some of those different tricks that are used, I won't say tricks, but underwriting manipulation, if you're massaging, if you will, to increase that cash flow, to maybe move product. And we just want to be aware of what those numbers are. And again, make sure that they're based on some sound underwriting. Not saying that doesn't mean the cash flow can't change and maybe change to a negative degree, but hopefully you're trying to avoid that as much as possible by doing some good underwriting and deals and informing clients on the differences and comparing and contrasting them.
Okay. An interesting question has actually just come in that I wanted to stick with you on, Nate. And actually, Keith and everyone, of course, there are a number of opportunities in the, in this alternative investment space. There's qualified opportunity zones, there's 1031 exchanges, there's straight funds, et cetera, et cetera. There's non-traded REITs, BDCs. But in general, and it may apply to all of them, do you prefer offerings that are solely focused on from a deal by deal basis? It's a sole property fund, or do you look for commingled funds? What's the positives and the negatives from either approach?
Well, I mean, I guess for the 1031 exchange, they're typically going to be, DST, which generally is going to be one property, sometimes a small portfolio of properties with most of the sponsors we look at. But certainly it's not a blind pool. You're going in and specifically which properties you're buying. In the case of the DSTs we work with, I mean, I'm not sure what they mean by commingled. I mean, we would never commingle our client assets, but going into a fund.
Let's go to a QOZ, for instance. So a qualified opportunity zone funds, you typically see either, a single asset QOZ, but you also see large funds tied to QOZs that are aggregating multiple assets within that fund. What are the positives and negatives from either approach? What do you prefer, if you prefer one over the other?
Yeah, I mean, there's a lot of advantages to knowing what the specific property might be, I guess, because you can kind of look at it and say this one specific area, and you're looking and underwriting more of a property. When I'm looking more at a fund approach, we want to typically the funds will usually have an asset or two in them that have been seeded. So you can kind of look at that one example and start looking at what they're maybe using as their underwriting or their pro forma on those specific properties. But then you're really going to want to understand what they're looking for going forward. To Ken's point, looking at what's the saturation like in that market and understand where they're looking and targeting, because it's an opportunity zone. Where do they see these places that they can buy and have an opportunity zone? And then for like John's point, like what universities are you looking at? What are the criteria you're looking at for where you're going to be putting these properties that are going to presumably be coming into the fund later? So you really want to understand what metrics they're going by as far as the different assets they're going to eventually bring into that fund.
Keith, what's your take? What's Inland's take on deal by deal funds versus, pools?
Yeah, we've done it. We've been on both sides of that, right? So we've done it both ways. I think from a sponsor perspective, it's efficient or more efficient to scale a strategy that is scalable by taking the fund structure. And there's some, those efficiencies, in my opinion, lead to better performance on behalf of investors. Take storage, for example. I mean, your average storage total project cost per property is between $10 and $20 million. It's a really small amount of equity to structure an entire offering around and go to market. And there's costs and expenses associated with that. So that was a structure we scaled in a QOZ fund type wrapper. To Nate's point, it's still important to show the market a meaningful sampling size of what the portfolio is ultimately going to look like out the gate. But there are pros and cons to both. Another nuance is timing. We've seen some QOZ funds in our market that the cap raise is, it was launched when the legislation was passed back in 2019, and they're still raising capital with $1 billion open-ended target. That's a long time to raise capital through a different spectrum of pricing, and your 10-year hold period requirement is really anchored on when the last investor gets in, right? So I think there are balancing nuances where you have to think about probably not too long a shelf life, but I think some amount of shelf life does give the sponsor an opportunity to deliver diversification and efficiencies, which should ultimately deliver, hopefully better performance.
And to Keith's point, there's generally going to be a single strategy in these opportunity zone funds that we see, or maybe a blend of a couple similar strategies, but diversification for our clients also is a key, whether that's doing a couple single asset, an example of opportunity zones, or going into a fund with a strategy and maybe a different fund with a different strategy as well.
Gentlemen, we're right up against the hour. I thank you very much. I have tons of notes and questions that I want to pursue, and we just don't have the time. But I thank you for all of your insights, and thank the audience for tuning in. There will be replays of this available on the DIYer website and via social media from different realms. But again, thanks so much. If you have any additional questions, feel free to email us at info@thediywire.com, and we'll share them with the panelists, and perhaps we'll get some more further insights. Look forward to do this again. Keith, gentlemen, really appreciate your time. Thank you so much.
Thanks, Aaron. Appreciate it.
Thank you.
Catch you later.